Options trading is a fascinating and complex part of the financial market where traders can control a stock or other assets without owning it directly. This allows for a wide range of strategic possibilities. A call option gives the buyer the right, but not the obligation, to buy an asset at a specific price within a certain period. This can be particularly advantageous if the asset's price rises significantly. Conversely, a put option allows the buyer to sell an asset at a predetermined price before the option expires. This can be a valuable tool for protecting against a decline in the asset's value. This system allows traders to speculate on price movements or hedge against potential losses in their investment portfolio. By using options, traders can create strategies that align with their market outlook and risk tolerance. The beauty of call and put options lies in their flexibility. They can be tailored to fit a variety of market conditions and investment goals. Traders can use these instruments to bet on both rising and falling markets. This dual capability makes options a versatile tool in any trader's arsenal. If a trader expects a stock price to rise, they might buy a call option. This allows them to benefit from the upward movement without committing to buying the stock outright. If they expect it to fall, they might buy a put option. This provides a way to profit from a decline in the stock's price or to protect existing investments. Importantly, the most money they can lose is the price paid for the option, known as the premium. This limited risk is one of the key attractions of options trading. This makes options a popular choice for those looking to limit risk while having the potential for significant returns. The ability to manage risk while aiming for high rewards is a compelling feature. Understanding options requires familiarity with certain terms and concepts. These foundational elements are crucial for anyone looking to trade options effectively. The strike price is the price at which the asset can be bought or sold if the option is exercised. This price is a critical factor in determining the option's value. The expiration date is the deadline by which the buyer must decide whether to exercise their option. Timing is essential in options trading, as the value of an option can change rapidly as the expiration date approaches. As these fundamentals are grasped, traders can better navigate the options market and make more informed decisions. A solid understanding of these concepts can lead to more effective and profitable trading strategies. Options trading is not just for seasoned investors. It is accessible to anyone willing to learn and understand the basics. With proper education and tools, even beginners can start understanding and participating in this dynamic segment of the financial markets. There are numerous resources available to help new traders get started. It offers a unique blend of risk management and strategic diversity that can cater to various investment styles and goals. Whether you are looking to hedge existing investments or speculate on market movements, options provide a versatile and powerful tool. The allure of options trading often lies in its high profit potential. This potential is what draws many investors to explore the world of options, hoping to capitalize on market movements. For example, if a trader buys a call option and the stock price rises above the strike price, they can purchase the stock at the lower price, sell it at the current higher price, and pocket the difference. This scenario can lead to substantial profits, especially if the stock experiences a significant upward movement. This leverage allows traders to amplify their returns significantly. By investing a relatively small amount in the option premium, traders can control a larger amount of stock, thus magnifying their potential gains. Similarly, with a put option, if the stock price falls below the strike price, the trader can buy the stock at the current lower price and sell it at the higher strike price set by the option. This can be particularly advantageous in a declining market, providing a hedge against falling stock prices. However, with high potential returns come high risks. The very leverage that can amplify gains can also magnify losses, making options trading a double-edged sword. The most immediate risk is the loss of the entire premium paid for the option if the market does not move as anticipated. This means that the initial investment in the option can be completely lost if the stock price does not move in the expected direction. For call options, if the stock price does not rise above the strike price, the option becomes worthless. The trader loses the premium paid, which can be a significant amount depending on the option's terms. For put options, if the stock price does not fall below the strike price, the same fate ensues. The option expires worthless, and the trader loses the premium paid. Therefore, options are often seen as high-risk investments, suitable only for knowledgeable investors. Those who understand the complexities and risks involved are better positioned to navigate the volatile nature of options trading. Moreover, options are time-sensitive investments. The value of an option is not only dependent on the stock price but also on the time remaining until expiration. As the expiration date approaches, the value of the option can decrease, a phenomenon known as time decay. This time decay can erode the option's value even if the stock price moves in the desired direction. The intrinsic value might be there, but if time is not on the trader's side, it can result in a total loss of the premium paid. This makes timing a crucial element in options trading. This aspect requires traders to not only be right about the direction in which the stock price moves, but also about the timing of this move. Predicting both accurately is challenging and adds another layer of risk. Despite these risks, many traders are drawn to options for the possibility of substantial gains. The potential for high returns can be very appealing, especially for those willing to take on the associated risks. With proper strategy and risk management, the benefits can outweigh the risks. Successful options traders often employ strategies that mitigate risk while maximizing potential returns. Options offer a way to leverage a modest amount of capital for a potentially larger payoff, but this comes with the need for a thorough understanding of how options work and a clear strategy for their use. Educating oneself and possibly seeking advice from financial experts can be crucial steps in becoming a successful options trader. In options trading, the terms intrinsic value and time value are crucial to understanding how options are priced. The intrinsic value of an option is the real tangible value based on the underlying asset's current price and the option's strike price. For a call option, if the current price of the stock is higher than the strike price, the difference between the two is the intrinsic value. For a put option, it is the difference if the strike price is higher than the current price of the stock. Time value, on the other hand, is the additional amount that traders are willing to pay above the intrinsic value. This value represents the potential for the option to increase in value before it expires. The time value is influenced by various factors including the volatility of the underlying asset, the time remaining until expiration, and the risk-free interest rate. As the expiration date gets closer, the time value decreases, a concept known as time decay. Understanding these two components is essential for any options trader. They form the basis of option pricing models, which traders use to determine whether an option is overpriced, underpriced, or fairly valued. By analyzing the intrinsic and time value, traders can make more informed decisions about which options to trade and when to trade them. In practice, most options are bought and sold based on their time value. As expiration approaches and the time value diminishes, traders must decide whether to exercise the option, sell it, or let it expire worthless. The management of these values, understanding their interplay and predicting how they will change is a critical part of successful options trading. Option prices are not determined in a vacuum. They are influenced by multiple factors that can either increase or decrease their value. Understanding these factors is crucial for anyone involved in options trading. The price of the underlying asset is perhaps the most straightforward of these factors. It serves as the foundation upon which the option's value is built. If the price of the underlying asset moves in a direction favorable to the holder's position, such as an increase for a call option or a decrease for a put option, the value of the option increases. This is because the intrinsic value of the option becomes more favorable. Conversely, if it moves in the opposite direction, the value of the option decreases. This inverse relationship is fundamental to understanding option pricing. The sensitivity of an option's price to changes in the price of the underlying asset is known as the option's delta. Volatility is another crucial factor. It refers to the frequency and magnitude with which the price of the underlying asset fluctuates. High volatility usually leads to higher option prices, as the chance of the option ending in the money, profitable, increases. This is because greater price swings increase the likelihood of the option becoming valuable. High volatility usually leads to higher option prices, as the chance of the option ending in the money, profitable, increases. This is because greater price swings increase the likelihood of the option becoming valuable. In contrast, in times of low volatility, options tend to be cheaper. This is because the underlying asset's price is less likely to move significantly, reducing the potential for profit. Options tend to be cheaper. Traders often track historical volatility, past price movements, and implied volatility, market expectations of future movements, to gauge this. Traders often track historical volatility, past price movements, and implied volatility, market expectations of future movements, to gauge this. By analyzing these metrics, traders can make more informed decisions, and implied volatility, market expectations of future movements, to gauge this. Understanding volatility is key to predicting option price movements. Time decay, or theta, represents the rate at which an option's value decreases as it approaches its expiration date. This is particularly important for the time value component of the option's price. As each day passes, the likelihood of the option being profitable decreases, thus reducing its value. This necessitates precise timing in options trading. As holding an option too close to expiration can lead to significant losses if it has not already moved favorably. Traders must be vigilant about the passage of time and its impact on their positions. Interest rates and dividends can also impact option prices, albeit more subtly. Higher interest rates often lead to higher call option prices and lower put option prices due to the cost of carry, the opportunity cost of holding a position in an option versus investing in risk-free securities. Higher interest rates often lead to higher call option prices and lower put option prices due to the cost of carry, the opportunity cost of holding a position in an option versus investing in risk-free securities, and lower put option prices due to the cost of carry, the opportunity cost of holding a position in an option versus investing in risk-free securities. This relationship is essential for traders to understand when making decisions. Dividends issued by the underlying asset can affect option prices too, typically lowering the price of call options and increasing the price of put options as they reduce the expected future price of the underlying asset. Typically lowering the price of call options and increasing the price of put options as they reduce the expected future price of the underlying asset, and increasing the price of put options as they reduce the expected future price of the underlying asset. This is because dividends are paid out of the company's earnings, which can lower the stock price, as they reduce the expected future price of the underlying asset. Understanding these factors and how they interact is essential for any options trader. By keeping an eye on these variables, traders can better predict price movements and make more strategic trading decisions. This comprehensive understanding can lead to more successful trading outcomes. Traders can better predict price movements and make more strategic trading decisions. This comprehensive understanding can lead to more successful trading outcomes and make more strategic trading decisions. With a solid grasp of these factors, traders can navigate the complexities of the options market with greater confidence and precision.